Good morning or good afternoon, everybody. Very excited to be up here on stage to talk about structuring Bitcoin Treasury company deals. A lot has changed in the last 12 months. I'm Alan Helm, co-founder and director of business development at Bitcoin for Corporations. We are the industry's premier networking and advocacy provider for companies running a Bitcoin Treasury company. And I'm joined here today by two very awesome individuals. I'll let them introduce themselves, though. Chris, let's start with you. Talk a little bit about your background, who you are, and what you do.
Christian Lopez. I head the digital asset team at Cohen and Company Capital Markets. We are an investment bank focused on both capital markets and a very strong focus on digital assets and crypto. And as a matter of fact, we were the investment banker that led the Nakamoto transaction in Bitcoin Treasury, along with ProCap BTC, which is Anthony Pompliano's, DJT, and several others in the altcoin space as well.
Hey guys, I'm Kingsley Advani, founder and CEO of Allocations. We oversee over $2 billion in assets, and we've structured about $50 million of investment into about 10 DATs, and some of which include Nakamoto, Satsuma, we've done Sol, a bunch of other Bitcoin and other DATCos. I personally invested in over 200 companies, and a bunch of them were DATs.
Awesome. So I want to frame up the conversation first, zooming out, not to earlier this year when we had the rise of all these Bitcoin Treasury companies and the DATs, but even further back. I want to start like 2020, 2021, when MicroStrategy made a decision to start accumulating Bitcoin on their balance sheet. So Christian, maybe walk us through, what is the MicroStrategy model, and talk a little bit about the converts that they were doing, and let's just tee up the conversation that way.
Yeah. I mean, so MicroStrategy, obviously kudos to them strategy now for taking a risk and going really hard at this strategy. I think Saylor saw the opportunity before everybody else and realized that as long as he can accumulate enough Bitcoin on his balance sheet, he can use the asset's volatility, which traditionally has a 70 or 80 vol, to create some financial engineering that can help him acquire more Bitcoin through convertible notes and other structured vehicles. And what he was able to do was eventually get zero coupon convertible notes, effectively paying zero interest rate because of the volatility of the asset. And he sold those converts to traditional convert investors that effectively delta hedge for their portfolio, and that's where they're generating their yield. Fast forward to a few years later, right? Eventually, he showed the market that this was doable. Not only doable, but it was working extremely well. And we'll get into it, but that's this past year saw a flurry of those happen.
And then Kingsley, maybe from the investor side, just talking about what was attracting some of this long-term capital for MicroStrategy. That obviously changes at the beginning of this year, but walk us through that.
Yeah, so MST, I think during COVID they saw they were sitting on a lot of cash, and they didn't have many places to put it. And with very low interest rates, high inflation, the dollar has been depreciating in value every year. So they wanted a long-term store of value. And so Michael Saylor figured out, well, let's put it into Bitcoin, right? And over time, they've built up their Bitcoin reserve. They own about 3% of all the total Bitcoin supply currently. And I think about 70 to 80% of their assets are digital assets. And they're generating about 500 million a year in revenue. So they were really first mover in this space and saw this opportunity for Bitcoin-powered corporations. And since then, we've seen the next wave of DAT companies. And I think, especially with Bitcoin for corporations, we've seen a real movement for every company to be a treasury company. And every company has the ability to hold Bitcoin on their balance sheet. So I think we're still early. MicroStrategy was the first mover, and I think we have a long way to go.
Certainly a long way to go and a lot of hard lessons learned in the last 12 months here. So moving forward, right, we're at the beginning of 2025. We're seeing this explosion in the Bitcoin Treasury and DAT space. It was almost too easy to raise capital, but maybe let's talk about, what maybe some of these early structures look like, Christian, on your end. I know you participated in a number of these.
Yeah. We were early in the game. once, like, what really changed for the rest of the capital markets was the 2024 U.S. election. As soon as the Trump administration won, that was a huge win for crypto. And at that point, everybody started saying, okay, how do we do a MicroStrategy copycat and go raise our own capital? CEP 21 was kind of the first to do it. The Nakamoto deal was shortly thereafter, which is one of the deals that we led, and it was a phenomenal ride. Early on, it really worked because it was new, it was exciting, and when you saw CEP raise, I forget, it was several $1 billion. They did some in kind, they did a convert in the small pipe. The stock popped, right? I think it was a SPAC, and it went from the $10 SPAC to I think $40 or $50 per share. And at that moment, the rest of the kind of crypto universe and investors, both retail and institutional, said, all right, hold on a second, something's working here. And then we raised $750 million for Nakamoto. That was the second deal that announced. The stock went from $1.12, which was the pipe price, to about $30 per share. And at that point, everybody's like, okay, there's money to be made here. And early on, it made sense, right? And you and I were talking about this the other day. Like any sub-industry, there's a liquidity pool, a pool of capital that understands and plays in the space. For example, like biotech investors, they invest and trade in biotech, and that's kind of their sandbox that they play in. And I think it's kind of the same for digital asset and crypto. And early on, that liquidity pool, it was kind of fixed size, but there were fewer DATs, right, than there are today. And so the liquidity per DAT was a lot larger. And because of that, you had more investors and traders to absorb that liquidity, to buy and sell the shares per each DAT. Fast forward 9 or 10 months now, there's 200 plus DATs, there's a ton of Bitcoin DATs, there's altcoin DATs, and that liquidity pool stayed fixed, right? That it's kind of the same size, if not smaller now, because the trade stopped working. So the liquidity per DAT got smaller, and that has really affected the ability for companies, management teams, boards to execute on the strategy, because that strategy very strongly relies on the volatility of the underlying stock and the liquidity. And if that doesn't exist, then you're kind of stuck.
So we have this tightening of liquidity pools, right? And we've also mentioned up here on stage already that every public company will have Bitcoin on the balance sheet, right? And so we have 250-ish public companies that have Bitcoin on the balance sheet out of the 50,000 public companies that are out there. So something's not lining up here. There are obviously many of these companies down the line with a long-term advantage is attractive. So Kings, I guess from your investor side, I guess early on in 2025, what were the attractive qualities of some of these DATs, and why were you wanting to invest in them?
Well, we've had about $20 to $30 billion of DAT fundraising this year. So there's been a high velocity of capital coming in. July had the highest. We had about $10 billion of fundraisers into DATs. But as Christian mentioned, the liquidity pool has been drying up a little bit. We've hit a short-term bearish market. Bitcoin is down about 30% from all-time highs of 126K in October. And we've had some macro sell-offs as well. We've had, tariffs. We've had the government shutdown. We've had some bearishness with the, Japan increasing interest rates and the carry trade risk. So there has been some macro bearishness this year. But I think, DATs are a long-term play. And I think it's important when structuring a DATCO, you need to be efficient, keep expenses down, not too much debt, and be able to weather out a long bear market.
Yeah, I mean, I would totally echo that. It's a long-term game, especially with Bitcoin. We all know. I mean, that's why we're here. We love Bitcoin. Some of the other DATs that started going out there, the management teams and boards got a little bit greedy. There were some egregious asset management fees. Board members getting paid like $450,000 a year just to manage a DAT, and I think investors got a little bit wary of that. But I try to tell my clients it's counterintuitive, right? But now is probably one of the better times to try to go raise capital and buy Bitcoin for your balance sheet. And it's challenging because the market's not there. If there's no liquidity, it's hard to get investors involved. But trying to find that long-term investor that sees the vision it's challenging, but it's the right thing to do. I mean, right now, a lot of the DATs, Bitcoin and non-Bitcoin, are at unrealized losses. Put aside strategy because they've been around for a while, but the ones that like launched and announced in 2025, you're kind of sitting at an unrealized loss. That's going to turn around for sure. But if you're going to launch, go now, because with rates coming down, midterm elections coming up for the U.S., it's much more likely that we're going to end up above where we are today.
So an open question to the two of you. We've talked a lot about the pitfalls that these treasury teams found out, whether it was, the bad pipe structuring deals, maybe SPACs not being the right way to go. Was there anything fundamentally healthy about the summer 2025 rush of Bitcoin treasury companies, or was it mostly like an opportunistic capital formation?
I think a bit of both, but I think it's healthy that there's more DATCOs, that, organizations like Bitcoin for Corporations was set up to help every company hold Bitcoin. So I think there's some bullishness for this, but also, as you mentioned, you don't want to have greed either. You want to have healthy long-term Bitcoin thinking, but you don't want to have greed. So I think we saw a little bit of both.
Yeah, there's both. I mean, there was so much money being made in the DAT space. You mentioned like $20-30 billion. Like I think it's a lot more overall globally. I mean, at Cohen, we did 10 billion of capital raise ourselves across the different assets and underlying. And that type of liquidity, that type of trading and price action, it's going to attract all types. It's going to attract long-term thinkers, and it's going to attract opportunistic people. What I think might happen in the next 12 to 18 months, and we can maybe get into this a little bit, is some convergence, whether that's M&A or activism. But we can touch on that in a bit.
That's actually going to be my next question here, right? So we've seen the pipes, the RTOs, the SPACs. We're shifting away from now. So this is the capital formation side. You're starting your treasury company. You need to raise the capital, but then after you raise the capital, is how do you acquire more Bitcoin accretively, right? And so convertibles were the way to do it. I don't think the shareholders like being diluted, so they're starting to look at preferreds now. But what mechanisms are at play now for these treasury companies to continue, acquiring Bitcoin in an accretive manner? That's not only good for the business, but also good for the shareholders.
Yeah, I mean, I can start there. The convertible, like the structured notes for treasury companies, is challenging if you're not at massive scale, because you're not going to be able to do the zero coupon convertible notes that are syndicated notes out to the large institutions that play in these, because there's just not enough vol, there's not enough size and liquidity to trade amongst each other, and not enough to like hedge. So it's challenging as if you're small to do those. So how do you actually start accumulating more BTC or more whatever? And frankly, that's challenging. I think people have to start thinking about ways to generate cash flow. I think that's where a lot of these will be heading. Not everybody. Eventually, folks will get large enough where they can use more financial engineering in order to acquire the Bitcoin. But absent that, there's got to be some sort of operating company underneath that's positive cash flow so that you can acquire the BTC.
I think we'll see more M&A and activism. We saw Semler Scientific acquired, and it was trading at a discount to MNAV. So I think we'll see some acquisitions of public companies trading at a discount to MNAV. And also activism for different DATs. If they're underperforming, shareholders will want to challenge that. And, are they doing everything they can to increase share price and increase Bitcoin per share? Or is there a need for new management?
The one thing on M&A that maybe I see a lot of faces out there that are managing Bitcoin treasury companies or are obviously involved. The one thing that I've run into a lot is everybody's a buyer. Like everybody that has a DAT, they're a buyer, but they're not a seller. Even if they're trading at like 0.6 MNAV, right? And I think there's a few reasons for that. One, just like a belief that we're going to be in a much better place and they're going to arb out that discount at some point. Two, we're still early in the game. I mean, for us that were very active, a lot of you out there, it's felt like 8 or 9 years that this has been going on, but it's been like 8 or 9 months. So it's super early. And a lot of us are barely through our first like public earnings call, right? So I think there's an element of ego that's getting in the way from people doing financially what the right thing is to do for your shareholders. The last thing I'll say about that is even if you gets some folks to agree on M&A. And one DAT's trading at 0.9 MNAV, and another DAT is trading at 0.6 MNAV. It's not a guarantee that shareholders will approve the deal, right? Because you might only trade to that 0.9 MNAV, or you might trade to some average of the two. And as a shareholder, if you're going from 0.6 to 0.8, that's not the best deal on the table. The best deal on the table is going from 0.6 to 1. And so I think there might be some more activism out there, folks that are a little bit more hawkish and kind of sharks in the water saying, hey, let's just acquire a large piece of this and just sell in the open market and are about that full amount, less small fees.
So we've talked about a lot of the structures here. I think one thing we've been briefly touching on but haven't gotten into too deeply is the team that's actually the executive team that's executing on these strategies, right? It's kind of funny. I always lump together in these Bitcoin treasury companies, there's two kind of buckets here. There are the long-standing Bitcoiners who don't have too much capital markets experience, but they really understand Bitcoin and they want to run a Bitcoin treasury company. And then you've got the guys that have 30, 40 years capital markets experience that know little to nothing about Bitcoin. And so there's this mismatch that's happening on these boards. So what makes a good executive team here? What are you looking for in terms of what are the best qualities on these boards?
I'd say you have to have both. You have to understand Bitcoin and capital markets. And ultimately, you want to be out there on TV, talking about your stock and driving more interest. So you need to understand Bitcoin and capital markets in general.
Yeah, I've seen that a lot. I think you want the face of the. I think you want the face of the DAT or of the treasury company to be more of a Bitcoiner. A lot of this is kind of retail driven, and eventually, as you start accumulating more BTC and you become larger, you might be able to start attracting more institutional capital. But that's when you have the capital markets person, a trader or banker or whatever, who spent years in the capital markets, working in the background, using those relationships. It's good to be out there talking to retail, but in order to really grow, you need that institutional capital to come in.
So next topic I want to get into here is a little bit of the jurisdictional arbitrage play, right? I mean, we're here in MENA, one of the most prosperous, places in the world. But the reality is when the Bitcoin Treasury play started, most of these companies are located, in North America. So let's zoom in on the region a little bit. Particularly Saudi, Bahrain, UAE, Kuwait. What is the opportunity here for these Bitcoin Treasury companies?
I think there's a massive opportunity in GCC for Bitcoin treasury companies. And if you look at the stock market caps, you have about $4.2 trillion of total stock market cap in the GCC. Saudi accounts for about 2/3 of that. You have about $2.7 trillion of market cap. Then you have the UAE, you have the Dubai financial market, and you have Abu Dhabi Stock Exchange, which is about a quarter of the total GCC. And then you have Kuwait, Bahrain, Oman, Qatar. So I think we're already seeing one of the companies, Barrage Group, has been an early mover in this space. They've started accumulating Bitcoin, and I think companies that dual list, not just on one exchange but on multiple, I think have a great chance of succeeding. And I do think the favorable tax regime in the GCC is attractive to investors. So I think there's a large opportunity in the GCC.
I mean, I couldn't agree more. The one thing that I'll add to that is, again, it's all about liquidity. The region here and the markets here are growing, obviously, but they're still small. And so they're doing all the right things in order to allow investors and capital to come into the region. And so once that happens, and once you get the volume and the capital coming in, there's going to be some really exciting things going on here, both in crypto and otherwise.
It might be a little bit speculative here, but once things get rolling here, what does that mean for the rest of these DATs in North America and in Europe? But Europe seems to be lagging behind a little bit in this space.
I think Europe's having a really challenge. They're having a terrible branding problem right now. Everybody's running away, and capital is fleeing. Yeah, I think the future here, as folks start coming, I think the dual listing is a great idea. Is tapping the local capital, family offices, pension funds, sovereigns, et cetera, that are coming in to participate. And I mean, I know these conversations, we're having them live with a lot of folks who are now starting to take a look.
I also think there's a lot of opportunity for the sovereign wealth funds to play a big role in the GCC for treasury companies. GCC has about a third of the AUM of all global sovereign wealth funds. So I think there's a huge opportunity for long-term investing, and I think the sovereign wealth funds in GCC can play a major role.
So I know we're starting to get closer to the end of time. I want to get us caught up to present day. We started off this conversation talking about a lot of positive regulation changes that happened in the U.S. But in the last 30 days, there's been a lot of interesting developments. Everything from the MSCI crackdown to even J.P. Morgan debanking the beloved Jack Mallers and Strike. So why is some of this pushback happening right now? Do Bitcoin treasury companies, need to be regulated more? And what is your overall take on the MSCI notice that went out?
That's it's very frustrating, right? Like
maybe let's give some context on the MSCI notice first too.
Yeah, I mean, so MSCI, the Morgan Stanley index, they effectively said companies that are in their index can't. I think it's more than 50% of their assets can't be in digital assets, right? Which is it's kind of more of one of those times when they're trying to administer the policy by retroactively punishing folks. And it seems completely unfair. This wasn't a policy that's in place. And I know MicroStrategy and a bunch of others are fighting it. But at the same time, by the way, JP Morgan debanked Maulers. They started doing some other funky stuff in the background. But at the same time, you have that same JP Morgan offering Bitcoin structured products on the BlackRock Bitcoin ETF. You have Bank of America Merrill Lynch saying that they can offer their clients up to 4 or 5% of assets in Bitcoin. Goldman Sachs bought an asset manager that has a Bitcoin ETF product underneath. And so it's kind of odd, and I'm not one for conspiracy theories, but it's kind of odd that while you have the large TradFi institutions kind of attacking crypto native people, while at the same time offering these products to their clients, I mean, they're playing a regulatory arbitrage game in a nasty way.
Kingsley, anything you want to add there?
I agree. I think the MSCI indices, their proposed rule on DATCOs exceeding 50% of the total assets in digital assets from being excluded is pretty crazy. It would be pretty bad if that was affected in January. I think there's a chance either way. If it does go through, then there may be major liquidations of some of the larger DATs because they'd be delisted from those indices, and some of the larger pension funds and institutions may be forced to liquidate some of their positions. So I think it would be bad for the industry. Let's see if it goes through. I don't want it to go through, obviously. And I also agree with Christian that JP Morgan, some of the other institutions have been playing both sides, that on one hand they're supporting Bitcoin and the other they're not. And I think the whole debanking thing is pretty crazy, but it strengthens the case for Bitcoin.
So, gentlemen, 45 seconds each here. I want to look forward to the future. What does the next wave of Bitcoin treasury companies do differently in terms of structure, capital size, lockups, investor mix, jurisdiction? What does the future look like for these companies?
I'd say they become more efficient, so they use less resources to do more, and they have clearly defined moats, whether it's jurisdictional, whether it's where they're based, whether they have an operating business that generates a lot of cash flow. So I think generally DATCOs will have to become more efficient.
Yeah, I mean, like what treasuries are now, that like ETFs are pretty like live, obviously, for Bitcoin and now with other assets. These companies, they're effectively closed-end funds, right? Or ETFs, but they're just more expensive ETFs. Like the expense ratio on BlackRock's and others is what, like 20 or 40 bips. Or, I mean, I think GBTC is the only one that has a really high rate because of the tax arbitrage. But like, if you're an institutional investor, and if you're, somebody that has Bank of America as your financial advisor, and your financial advisor says, hey, you can go buy IBIT, and it's 40 bips, or you can go buy 21 or ProCap BTC, and they're getting paid this much, and there's this much dilution from the management fees. If all you're doing is holding Bitcoin as a DAT, it's a pretty obvious answer what the right investment is from you, just financially speaking, because the expense ratio is just a lot lower. And so the reason that somebody's going to invest in you as a DAT is because you are differentiated and you're generating outsized yield that makes up for that expense ratio that you have to pay. So what you have to start thinking about is, how do I generate that outsized yield? And you have to get creative, or you have to go back to the basics and go, acquire a business or acquire cash flow so that you can start stacking BTC.
I think that's a perfect way to close this out, gentlemen. That's all the time we have today. Christian, Kingsley, thank you so much.
Thank you.
Thank you.
Thanks, guys.